There's one trading strategy that I use every single day. It's stupidly simple and extremely reliable. And it's the reason that I'm able to make consistent profit from the market like this, and this. The strategy we're about to see is so simple that even a complete beginner can't get this wrong. I'm going to show you the entire strategy and the exact 3 simple steps you need to take to execute this strategy every day yourself. Then I'm going to show you some real trading examples of this exact strategy in real market conditions, just to prove to you how effective it is and to show you that it works. So here's what we're going to be going over in the video. You're going to learn how to get consistent profit using a simple tested strategy in the first 90 minutes of the session. You're going to learn one setup that's repeatable and mechanical, and you're going to be able to trade this model without having to have any bias, no indicators, and most importantly, no confusion. You don't really need to know whether you're going to be bullish or bearish. All you have to do is just focus on executing the strategy day in and day out without having to worry about anything else. The strategy can pretty much be broken down into a couple of different steps. So the very first thing we're going to do is identify the key candle. This is the candle that essentially holds all the information that you really need in order to execute this strategy. We're then going to go ahead and mark out our key levels. It can all be done in less than 60 seconds, which is amazing. And then I'm going to move into execution models and show you how you actually enter the trades very mechanically and in a very predictable way. I'll even show you a very interesting and unique way in which you can increase the probability of the trade. So this is going to massively increase your win rate. Then I'll walk you through the entry, stop loss, and the fixed target that you need to be going for in these trades. And what I'm actually going to do is I'm going to show you that whilst we're using real examples on a chart so that I can plot it for you and explain why we're going to be positioning things in the way that we're positioning it. Now, a question that I get a lot in the YouTube comments, especially over the last few videos, is what session are we trading and what time are we supposed to be trading? Your trading sessions are essentially broke up into different brackets. You've got the London session, you've got the New York session, and you've got the Asia session. Now, what I'm interested in specifically is the New York session. That's where all the volatility is. That's where most of the action is going to be happening for you to be able to find the move that we are specifically looking for. So an important detail about this model is I want you to actually avoid higher time frames completely. This right here is the hourly chart. And if you look at the range we've got here from top to bottom, on the hourly chart, this is a very, very big range. For this particular model, I don't want you to look at this. I don't want you to look at the hourly, the 4 hourly. We're actually going to be just focused on lower time frame price action. So when you are starting your trading session, the first time frame we're going to use is only the 5-minute time frame. And you're going to go ahead and you're going to look for the 9:30 Eastern time candle. So it's very important that you're actually at your trading desk before this candle is printed. I'd really recommend, 9 o'clock Eastern time, just be at your desk like half an hour before, just so you can be prepared and you're not like rushing or anything like that. All right. So the actual candle for 9:30 a.m. you will see right here is going to be printed obviously at 9:35. So once you find your 5-minute candle, all you're going to do is you're going to mark out the high like this, and you're going to mark out the low just here like this. And what that actually ends up giving you is your 5-minute range. Now, this range is extremely important because that's really where the volatility is going to occur, and that's going to allow us to see what we should be doing next. Now, for the next step, we're going to wait for a 1-minute candle to close outside of the 5-minute range. So what I have here now, this candle pattern is essentially the 1-minute time frame, but you can still see that the 5-minute high and the 5-minute low are still marked out. So you can see right here, this little candle right there is closing outside of the range, right? And we know it's outside of the range because it's printing above this green line, okay? So as soon as this candle prints outside of the range, we now know that we can go ahead and look for an execution at that point. And then the final step is once the candle has printed outside, you can see right here, the 1-minute candle right there has printed outside, we would look for the execution and we would be looking for a continuation entry, meaning it's a trend model tape. So because price is moving in that direction, we are simply looking to ride the momentum into the same direction and catch a move in the same direction. So how do we do that? Well, before we move into the actual execution, there's one little thing that I want to show you that's very, very important to price action when taking these setups. And what that is the characteristics of the candle. So if we look at this example right here, what I specifically want you to look for is a fair value gap to form inside price action when it's printed. When you see a fair value gap like this, actually pushing outside of the range, so this one you can see is closing above the range, right? This fair value gap is closed above the range. This now has become an incredibly higher chance take, all right? Much higher probability for this particular execution to work out, because a fair value gap gives you a lot more conviction in the direction that price wants to go. It's extremely important to understand. So again, if this was going to be going to the downside, what I would be wanting you to look for is when price is trading down like this, I want you here to be looking for a fair value gap to be printing outside of the range. It's really important that price, first of all, prints outside the range. But if that fair value gap actually pushes outside, you've got a fantastic opportunity to take a trade at that point. Now, when it comes to entry models, there's two particular models that I'd like to show you. The first model is entering on the fair value gap candle close. So what does that mean? This is your 5-minute high range. This is your 5-minute low, just to remind you. And we can see here that this particular candle right here has got a fair value gap. And this candle right here, the one next to it, has closed outside of the range. In order for this candle here, this middle one, to be a fair value gap, you have to actually have a 3-candle pattern, right? So you have to have 1 here, you have to have 2 here, and you have to have 3 just there. All right. If this third candle doesn't print, then this is not actually a fair value gap here. So you're going to wait for this candle to be printed. And as soon as it is, you can enter the trade. That's why the entry position is on this candle and it's at this level here. We're not entering the trade here. We're not entering here or anywhere down here. We are entering up here where the candle actually closes and it gives us confirmation to enter the trade. Confirmation is everything here, right? So once you get the confirmation, you enter the trade and you will see that price moves very smoothly and hits the target pretty clean. Also, guys, for anybody that wants to simplify their trading and get to profitability faster, check out my trading course, The 90-Minute Trader, where you get access to my entire trading strategy along with my advanced entry model strategies as well. You also get access to my Discord community, daily market analysis from me, and a ton of other resources that's going to get you to profitability faster. I'll leave a link in the description below if you want to go check that out. Now, the second entry model is a little bit different. What we're looking for here is when price closes outside the range, we are looking for a push up and then a pull back so we can go ahead and enter. All right. So when you go ahead and get a retrace and a pushback from the gap, generally the reason that you're getting this reaction is because you are just retesting this whole range. The way this model works is price has to, number one, close outside the gap like this. All you're going to do is you're just going to wait really patiently. You're going to wait for price to retrace back down here and wait for it to tap into this gap, which it does right here. And actually what you will see is this particular candle is the one that comes into the gap, right? Into this big 5-minute range. You can see it taps in and it pushes out, right? So as soon as this pushes out and you can see this candle has closed, then you can enter right here. All right. You would enter once this candle is closed and you've got a bullish reaction or a bearish reaction. If you're doing this the other way around, you would look to enter the trade as soon as you get the reaction from the gap. We've just gone over 2 entry models on how you can execute this strategy. What I want to do now is go ahead and look at real examples of how you can apply this in a real market condition. So I'm going to show you the charts from today because this setup actually occurred just a couple of hours ago. So it's a great example. And we're going to go ahead and look at the 930 candle on the 5-minute chart. I'm going to go ahead and mark out my high and the low, just as I explained earlier. And then all we're going to do is switch over to the 1-minute chart. And we can already see that price is starting to move up in the range here. So let's go ahead and see how this works out. All right, so you can see here that we have printed outside the range. And what I'm going to do is just bring the candles back to here. So we've got an idea of what's going on. We do want to see if we've got a fair value gap here. Now, unfortunately, we don't really have a great gap here. We've got a very, very small gap here. What the model suggests is that if you have a fair value gap that's printing outside of the range, then it's a valid entry. Now, is it a good gap? Not really. It's tiny, but it's a gap. So I will go ahead and I will execute this model exactly how we've outlined in strategy. The entry would be this candle. And the reason that it would be this candle is because in order for this candle to have a fair value gap, for it to be valid, this candle has to print, right? So the entry actually works from here. We would put the stop at the bottom of the fair value gap candle, which is just there. And all we're going to do is target 2R, right? So if you look at the middle here, you'll see my risk to reward ratio. All I want to do is I want to bring that to 2. Okay. And my stop loss is just going to go at the bottom of the candle that has the fair value gap. So you can see that the gap is here. Then what that means is I want this stop to be just at the bottom of the wick. Okay. It's really important that you give your trades room. I always talk about this. And in this model, we want to be using the gaps and the full candle of the gap, okay? And in terms of the actual risk to reward, I want you to go for a 2-hour trade. The reason that I say this is because a lot of the time trades will pull back. And remember, we are not trading with analysis of the bias of the day, all right? So what that means is that if the market is really bearish, right, we don't really want to be taking a very, very big trade into a long position. If the market today is very bearish, we don't really have to take a big move. All right, we're just looking for the small kind of scalp move. So that's why it's really important that we're just looking for 2 hour here, a small move, nothing crazy. We're going to get the move and we get out. Right. So let's just go ahead and see how this trade plays out. So that goes ahead and hits target nice and clean. So let's go ahead and take a look at another example here. I've gone ahead and I've gone to the 5-minute chart. We're just going to draw the high and we're going to draw the low. Switch over to the 1-minute time frame. And again, we have our range. So let's just see what happens with price here. So again, price comes up. We have a great fair value gap here, which is pretty much the exact model that we are looking for. And because this candle has printed outside of the range, we can go ahead, we can take our entry here. Because this candle has printed outside of the range, we put our stop at the bottom of the fair value gap. As I said, we include the wick, okay? And again, we are looking for a 2-hour move. So again, just look at the risk to reward ratio. Make sure you are going for 2 hour and do not push it any further than a 2-hour move. Okay, just like that. And we can see how the trade plays out. Okay, so really nice move. Really there's literally no drawdown in this move or anything. So that's great. So here we have our third example. Once again, we are on the 9:30 time frame here. I'm going to bang out the high here. Let's plug in the low here. Switch over to the 1-minute time frame. And let's take a look and see what happens with price within the range here. This is a really great example of a situation that's quite difficult to trade because when we look at this, it looks quite nice because we have a fair value gap, right? That has printed outside of the range. But if you look at the third candle, our entry model essentially would suggest that the entry has to be here. Okay, now that is quite a big move for us because now the stop has to come all the way up here. So it's a much larger stop. So in order for us to achieve a 2-hour trade here, it's going to be pretty difficult because now price could retrace and go and stop us out essentially. But we're not here to get every single trade right. We want to see how this really plays out. So let's go ahead and see how this works. Okay, very, very choppy, this one. All right, cool. So in this example, we got stopped out. And the reason we are being stopped out here is because the 2-hour move is too big for this scenario. And the reason that is because this candle has printed really far down. So how can we resolve that? How can we find a way to correct a situation like this and maybe actually find a way to be successful with this, right? Well, number one thing I would suggest is figure out where your 1-to-1 ratio is. So 1-to-1 is around about here, okay? When your trade reaches your 1-to-1, and what I mean by that is let's just say, for example, this risk here, the stop here is worth $250. If price comes down to $250 and you do 1-to-1, what I want you to do is I want you to get your stop loss and you're going to move it to break even. All right. So now what this means is that if the price decides that it's not going to play well with you, then if price does retrace like this, guess what? You don't lose any money. All right. You're safe. And that is really the correct way to actually manage a trade and to manage your risk, right? So remember the rule there. As soon as you get 1-to-1, if price moves 1-to-1, move your stop to break even so that if price does retrace, your account is safe. So we didn't win that one, but we would have broken even if we followed that rule. Here's another example, 9:30, we're on the 5-minute time frame, and let's head over to the 1-minute. And let's take a look and see what happens to price action here. So you can see that price is trading outside of the range. Now, what instead we have is price trades out, it comes back into the gap, into that 5-minute gap range. And you can see this particular candle, again, it's the one that I showed you in the example earlier. This candle comes into the gap here and it pushes out. So because I get this nice bullish reaction from it trading into this range, I am now comfortable entering the trade on the next candle, right? So this is pretty much where the entry would be, where your fill would be, because you would be waiting for this candle to finish printing, and then you would move into your entry. In terms of my stop, I would simply be looking for the relative low, which is just here. And then I would look for, once again, the 2-hour move, because we're not trying to be greedy here. We're just trying to be systematic. All right. You would see, if we did take that trade, how would it actually play out? There we go. So target would have been here, just here. So that is a really nice example of the retracement model for this particular strategy. This model's been working extremely well for me. I really recommend you go and backtest this, try it out for yourself. I've got a bunch of students in my Discord that are using this model right now who are getting really great results. And if you want to check out my trading community, as well as my full trading strategy and advanced models that I use, then go ahead and check out my course, the 90-Minute Trader, where you can get access to all the different various strategies that I use, as well as a bunch of additional resources that are going to get you to profitability faster. I'll leave a link for the course in the description below if you want to check it out. And with that said, thank you so much for watching this video. I hope you find this model useful. Please go ahead and check it out, use it, and comment on this video and let me know what you find when you're backtesting it. If you enjoyed this video, make sure you hit like and subscribe to the channel, and I'll see you in the next one.